Good afternoon. Thank you for coming by to listen to our story on Digerati Technologies. I am the CEO, Art Smith, and I'll be going through about 15 slides and open up for Q&A. So let's go through some highlights on Digerati, kind of at a glance here. The company is based in San Antonio, Texas. And I don't think it's on the presentation, so I want to point out that the company trades under the symbol DTGI on the OTC QB exchange. So the company's got a successful track record. The predecessor to Digerati, with a slightly different telecom strategy, was a recipient of Deloitte's Fast 500 and Fast 50 award for recognition as one of the fastest growing technology companies in North America. The current business model is a combination of, it's a dual path strategy consisting of M&A as well as organic growth. And we've had a history of successful integrations since we started this business model that I'm going to talk to you about today. That includes 6 companies that are mentioned below: Synergy Telecom, T3 Communications, Nexigi, Active PBX, Next Level Internet, and Skynet Telecom. Currently, we operate in 3 states, and I'll go into that shortly. We have 45,000 business users on our platform, and we are a UCaaS provider, or Unified Communications as a Service. Essentially, we provide any type of telecommunication service over the cloud or over the internet with no legacy infrastructure whatsoever. Currently, and this has been disclosed in some of our recent press releases of acquisitions we've made or completed, we're at an annualized run rate of nearly $32 million in revenue. So our customer base consists of small to medium-sized businesses, primarily in California, Texas, and Florida. Number 1, number 2, and number 4 in terms of GDP size in the United States. So we're operating in some top states here in the U.S. The sectors that we serve include a variety of industries: real estate, professional services, healthcare, banking, and financial services. Our service offering is essentially, as I mentioned, any type of telecommunication service that includes voice, data, and also the delivery, as we describe it, of digital oxygen. We believe we've got a well-defined investment thesis, right? Our management team, which I like to think of as telecom veterans that have moved into the cloud, have over 125 years of combined telecommunications experience. We're executing, as I mentioned, on a dual path from a strategy standpoint, which includes organic growth in a high growth market, which I'll go into shortly, as well as acquisition of smaller regional operators that provide the type of services we provide in specific markets within Texas, Florida, California, or anywhere in the United States. One of the key fundamental things to know about the business is that it's a recurring revenue business model. Under contracts with business customers from 1 to 5 years. You see a sampling there of some of our customers like Bank of South Texas, Luna Grill, ExecuPay, and First Florida Integrity Bank. So our growth initiative is really multifaceted. We're looking to secure adequate growth, or adequate capital, I should say, for our growth. About a year and a half ago, we secured a financing facility with a funding source by the name of Post Road Group out of Stamford, Connecticut. They had obviously seen our track record over the previous 2.5 years, and we secured a $20 million facility to continue with our M&A strategy. But we want to position the company in the capital markets, preferably on a primary exchange, in order to really balance out the equity side of the equation with the debt. We're looking to acquire synergistic businesses to ours. And as I mentioned, these are smaller regional operators that do what we do in particular markets or specific markets within Southwest Florida, Central Texas, Southern California. And again, we're looking to drive growth both through the organic execution of our plan as well as continued M&A in a very fragmented market. And the only thing I can disclose today about our uplist plan is that we have filed an S1 that will be amended soon in order for us to continue with that objective. One of the things that we really like to point out is that our M&A strategy is very disciplined. We're not just out there buying revenue. When we looked at the landscape and realized early on that it was a very fragmented market littered with smaller regional operators that, quite frankly, were doing a better job than the bigger guys. And when I say the bigger guys, the Ring Centrals of the world, Vonage Business, 8x8. They were doing a better job of taking care of that higher touch, small to medium-sized business customer. And we realized that there was a lot of fragmentation out there, and these smaller regional operators that were anywhere between 2 million and 10 million in annual revenue had limited exit options. They were too small to attract a private equity group. They were too small to attract a larger pubco, and we realized that this is a great opportunity for us to consolidate some of these smaller players with limited exit options into our pubco. And that's exactly what we've done. And again, as I mentioned previously, we've completed 6 acquisitions to date and proven out concept. One of the things we look for in our acquisition targets, which is kind of the first box that we need to check, is that it's got to be on the same technology stack that we're on. And that's important due to integration and cost synergies that we need to realize within a relatively short period of time, within 6 months to 9 months. The other key part that we look for in these operators is that they have low churn or attrition relative to our larger peers. And the companies we've acquired, because they've done a great job of taking care of their small to medium-sized business customer in their local market, are typically below 0.5% churn versus our industry peers, which are anywhere from 1.5% to 2%. So that's important to us. And the last item that's really key is that they've got to be that size that I mentioned before, somewhere between 2 million in annual revenue and 10 million in annual revenue. Why? Because at that size, they're typically they're not banked. They're a mom and pop, closely held corporation that we can look to conduct a transaction. So here are the numbers behind our history of accretive acquisitions. It started back in December of 2017. We made our first acquisition, which got us to annualized revenue of about $700,000. The following year, in 2018, we completed our second acquisition here in Southwest Florida, up in Fort Myers, Naples. That got us to about $6 million in annualized revenue. We then proceeded to close on 2 transactions the same day, simultaneously, here in Miami, or south of us here in Miami, I should say, right? The acquisition of Nexigy and Active PBX got us to $14 million in annualized revenue. And in that transaction is when we secured our partner, our financial partner, Post Road Group, that has allowed us to continue with the execution of our M&A strategy. Most recently, in December of 2021, we secured or acquired Skynet Telecom based in Texas. And then in February, we closed on the transaction with Next Level Internet out of Southern California in San Diego that got us to a run rate of $31.5 million in annual revenue. And I have some slides coming up on the Ebitda Performance. And what I can say is that typically our acquisition targets are, if they're doing a good job of running their business, they're somewhere in the 15% Ebitda range as a percentage of revenue. And through our synergies and through our playbook on integration, we're able to take that to north of 20%. So our recent acquisitions, which there's some news out there on that, we have not, our financial results don't reflect the integration of these assets yet. You won't see this information on our public filings until the following, Qs coming up in the 3rd and 4th quarter. Skynet Telecom, again, a company based in San Antonio, Texas, where we're based, ideal for us. It was just geographically the right decision for us in terms of an acquisition. It was on the same technology stack that served the small and medium-sized business. We added 500 business customers and 5,000 total users through the Skynet Telecom acquisition. Next Level Internet out of San Diego, California, our largest acquisition to date that we closed on February 4th, added about 1,000 business customers and 12,000 total users, which got us to a total user base of 45,000, as I mentioned previously, and 4,000 total business customers. And again, this is all recurring revenue under contracts from 1 to 5 years with business customers or municipalities. So a little bit on our products and services. When we started this business model, we always knew that UCaaS, or cloud-based communications, was going to be kind of the anchor or the core product for the business. As we've made acquisitions, we've moved into some other product lines, which include SD-WAN, include the delivery, I like to say, the delivery of digital oxygen, which is essential for these businesses that are now living in the cloud. And so right now, as you look at it today after these recent acquisitions, we're about 60% UCaaS and 40%, call it data-centric services like SD-WAN and the delivery of digital oxygen, which could be fiber connectivity, wireless connectivity to that small and medium-sized business. As I mentioned in the second slide, we serve a variety of industries, and there's no concentration risk, right? With the multiple, at this point, 4,000 customers, with an average ARPU at this point closer to $800 per customer, there's just no one customer that represents more than 2 or 3% of the business. So there's no concentration risk. And we do serve a variety of industries, which include healthcare, hospitality, and retail. So some facts and figures on the market opportunity. Because of the fact that a lot of businesses are now migrating to the cloud, and by the way, most businesses in our sector of the market, the small and medium-sized business market, upwards of 60% have not migrated to a cloud-based telecommunication solution. That means they're still living in the legacy world. They still have legacy infrastructure at their local office or local business, or their connectivity solution is still legacy-based. So that represents a significant opportunity for us as businesses continue to migrate from their legacy telecommunication system to the cloud, which is where we come in. That in itself in 2020 was about a $39 billion market opportunity, which is expected to grow to $210 billion by 2028. Another subsector of our market is CCaaS, or call center as a service, or contact center as a service. And that solution is actually embedded, that call center application, which a lot of businesses need to use for their marketing of their services or supporting their customer base. That is actually a high demand solution for us that's integrated into our platform when we provide a service to a small to medium-sized business. There are 32.5 million small to medium-sized businesses in the U.S. And again, we're in California, Texas, and Florida. Fortunately, with two of them are very pro-business states, and in total there's right at 10 million businesses in our sector of the market within those three states. 10 million out of the 32.5. So as we looked at the landscape several years ago and executed on our plan, there's a couple things we realized. Number one, as I mentioned previously, businesses were still migrating away from their legacy infrastructure to the cloud. That in itself represented a significant opportunity for us to capture market share. We also realized that there was an evolution coming, which I'll describe as Wave 3. Wave 2 being, again, that business migration from on-premise or legacy infrastructure to the cloud. Wave 3 being the need for integration with third-party software that is also cloud-based. And what we really realized early on was that if we could help our customers engage with their customers through other tools, CRM tools, messaging tools, video solutions, that would create a lot of stickiness for our product. So we started down that path, and really with a strategy of integration with partners' solutions, which required not a whole lot of development. We call it low code, no code, and positions us for this third wave that's coming. It's already started, and we want to be very well positioned to stay relevant as we move into that third wave in our industry. So if you look at the competitive landscape, you'll recognize these names: Vonage, RingCentral, 8x8, RingCentral being the behemoth in our industry. Sorry about that. RingCentral, I think, is always been the leader, at least since we've been executing on our plan. But one thing that I want to point out about our competitors, and I think it'll actually continue when you look at the transactions like that Vonage just entered into with Ericsson. They're looking to move up market. In order for them to move the needle, these larger operators are moving up to the Fortune 500, Fortune 1000 segment of the market, and that's perfectly fine with us. So what we're seeing out there on the street is that the small to medium-sized business, again, that high-touch, local-touch, small to medium-sized business is not going to be the beneficiary of that type of service support strategy from the bigger operators. That, of course, presents an opportunity for us. If you look at our current market cap, again, we're trading on the OTC, but we're trading at a significant discount to the multiples of these larger operators. Obviously, they're much larger, but we feel that we've got a really good growth strategy with our M&A plan, as well as specifically targeting the small to medium-sized business. The most recent transaction that was announced is Ericsson's acquisition of Vonage. They paid 4.4 times sales for Vonage, and quite frankly, that we believe that that's going to be favorable to us, as Vonage probably, or Ericsson will likely decide to continue moving up market to serve that, again, that Fortune 500, Fortune 1000 segment of the market. So some financial highlights to go through. What you see here on the bar graph is our revenues reported for our fiscal year end, which by the way is July 31. So in April we will end our third fiscal quarter and report that by June 15th. So you will not see, if you look at the 2021 revenue of 12.4 million, that obviously does not reflect the most recent acquisitions that we've made. Those will be reflected in upcoming quarterly reports. But as I mentioned and we've disclosed in press releases, our annual run rate is just under 32 million or 31.5 million in revenue. I can disclose or talk about some highlights for the first half of the year. We had a 60% increase in revenues when you compare the current fiscal year or half of the current fiscal year to the previous fiscal year. Our Ebitda or adjusted Ebitda was 526,000 on a consolidated basis, and our operational Ebitda was right at 1.3 million. The reason we report it that way is we obviously, as we're on the M&A path, there's a lot of transactional costs and expenses associated with the M&A strategy that we're under. So we typically exclude any one-time expenses and non-cash expenses when we report adjusted Ebitda or operational Ebitda. We believe the operational Ebitda is actually a really good indicator of our performance and how we're doing with our M&A strategy. So as you can see, we've grown from fiscal year 2018, 2 million in annual revenue to right at 12.4 million for fiscal year 2021. And of course, we'll report fiscal year 2022 at the year end July 31 of this year, which will come out in October. So a little bit of background on our executive management team. Between us, primarily me and Craig Clement, we've been involved in ventures or started up ventures that have led to over $2 billion in market value. A couple of companies that I'd like to reference. The predecessor to Digerati was Atsi Communications. That's a company I started with a different, I founded that company, but it was a different telecom strategy. It was more international in scope, focused on the markets in Latin America that were deregulating and demonopolizing. We took that company from scratch basically to, we took it public and listed it on the American Stock Exchange back in the day, and it reached a value of about 615 million. As part of that strategy, or as part of that business, we launched a subsidiary, a wholly owned subsidiary by the name of GlobalScape, which we also started from scratch and built it up, spun it off to our shareholders of ATSI, and that company went on to list on the NYSE, and it reached a peak market value of about 300 million before it was sold for all cash about a year and a half ago. Craig Clement was also former CEO of XPEL Technologies, which has done tremendously well. Another company based in San Antonio that is, I think their current market value is about 1.5 billion. Craig was responsible for taking that company public back in 2005, 2006, and that company has done extremely well. Antonio Estrada, who's our CFO, has 23 plus years of experience in the industry. Obviously, he's been instrumental in helping us execute our current plan. To date, he's got 7 acquisitions under his belt. And so we feel we've got a good playbook here for continuing to do what we do. I think what I'd like to leave you with is, number one, relative to our peers, we feel we're definitely undervalued. We've proven that we can execute. Obviously, we have a history of success, but we believe firmly that the current business model is what we need to stick to, and we just need to do more of it. When you're in a very fragmented market like what we're in, you do not lack M&A opportunities of these smaller regional operators. They're scattered throughout the United States. There's thousands of them out there. We actually turn away opportunities due to the fact that it may not meet our disciplined or our criteria for our current business model. So we believe we can create significant value with this continued strategy of M&A and organic growth in the UCaaS space. With that, I'll open up to questions. Yes, sir.
M&A integration, you've done that successfully. On Skynet, you mentioned that it was a similar technology stack. Obviously, across your industry, there
our secret sauce is that we're keeping it simple, right? We're sticking to the technology we know. And again, one of the key things we look for is that it's on the same technology stack that we're on, right? That's important to us because we know how to integrate that technology. You don't have to retrain your help desk. You don't have to retrain your customers. Remember, if your customers are coming into a different environment, different portal, when they've been migrated, that's a problem. You're going to have to train them on that, right? So sticking to the same platform and same technology stack is really key to everything we're doing, right, in terms of integration. We have made the decision to stick to that until we were larger in scale, obviously until we've got more Ebitda production, right, that maybe we can apply towards a SWAT team, right, a technical SWAT team that can help us with the integration of other types of technology stacks, whether it be BroadSoft, right, whether it be FreeSwitch, right, as an example. But right now, I think the key to our strategy is just staying disciplined and not sticking to our business model, which again, same technology stack, 2 to 10 million in annual revenues, maybe a little bit north of that based on next level, and then little to no, low attrition or churn relative to our peers. And that's all we're going to continue to do for the foreseeable future.
Your stock has lagged, and I was just wondering, about the prospects and the fact that you're actually, the run rate revenues are ramping up largely in terms of acquisitions. Do you feel like the market would like to see you make more acquisitions? If so, what is the timeline in terms of talking to the mom and pops and so forth? Because I would imagine there may not be as sophisticated as maybe some of the larger operators, and what your thoughts are in terms of the timeline in getting a deal done like that. Or do you feel like it's maybe that the investors don't have a little understanding about your financing options? Or do you feel like it's that you need to uplist to actually be on the exchange because you've kind of been at the whims of what has happened recently into the OTC market?
Yeah, look, the last thing you mentioned is important because we believe being on an obscure exchange is certainly challenging. I think we know of people that have been eager to buy our stock and have a difficulty doing that, right, on an OTC exchange. It's just not easy for anybody to go out there and do that. So we think that in itself is certainly a problem, which is why we need to uplist this company to a primary exchange, right? But back to your other comments, we do have a playbook to accelerate our acquisition strategy, and one of the reasons for uplisting is also to have a currency that we can use for that transaction. Quite frankly, an OTC stock is not a currency you can use for these types of transactions, right? So that's important. The other is we actually have streamlined the entire process from due diligence all the way through LOI, all the way through definitive docs, and we have very specific docs for an asset purchase or a stock purchase that we've outlined that allow us to get through a transaction in short order with the acquisition target. And by doing that, again, streamlining the entire process from early stage due diligence, LOI, all the way through to closing, we believe we can get that down to 3 to 4 months with our acquisition targets. Now, historically, we've had to balance that out with access to capital, right? Post Road has been a big help. They helped us close these last 2 transactions that we closed within about 45 days of each other. But we firmly believe we can accelerate that acquisition strategy or execution of that on a primary exchange and access to a true, equity capital market. So, and the opportunities are out there for sure. There's no doubt. We do not lack opportunities on the M&A side. Yep, 1 minute. Any other questions? In full disclosure, I learned just before the presentation of the passing of one of our key members of our team. It's been hard for me to keep this composure here for the presentation. I appreciate your patience. His name was Ken Ryan, and he was one of the first 5 team members that helped us launch this business model. I worked with him for 12 years. He was a friend, and I'm going to miss him. And I just wanted to apologize if I lacked some composure today. But I appreciate your time. Thank you.